This video examines the global trade finance gap, a $2.5 trillion constraint on commerce, and explores how this challenge is viewed through an investor's perspective. Global trade demand is rising, yet funding capacity has not kept pace. A $2.5 trillion financing gap persists, representing roughly 10% of all global merchandise trade volume. Smaller firms continue to face the highest barriers to entry. While rejection rates have fluctuated, structural friction and high compliance costs remain major hurdles for small and medium enterprises in accessing trade finance. This financing gap is structural. It is driven by limited risk capacity, liquidity constraints, high compliance costs, and a lack of information interoperability across the global trade finance ecosystem. A large gap does not automatically translate to an investable market. To move forward, investors must prove asset performance, ensure operational viability, and find ways to achieve scalable economics. Financely structures trade opportunities by focusing on the underlying commercial cycle. This includes arranging letters of credit, managing recurring trade finance flows, and placing capital with banks and private credit providers. Success in this market requires converting access into repeatable, risk-adjusted economics. This involves verifying trade activity, managing compliance costs, and maintaining rigorous underwriting standards. Closing the gap requires more than just capital. Key strategies include expanding usable liquidity, reducing compliance friction through digital processes, and designing outcomes that target underserved segments effectively. By focusing on the buyer order and supply route, we can turn a systemic gap into a finance-ready opportunity. To explore structured trade solutions, visit financely.io.